Have you ever wondered how these super investors beat the market time and time again? Well, I've done a bunch of researching trying to find out why these so called super investors outperform us and all other investors. And it might actually be simpler than you think. First of all, super investors are great at holding stocks, and being able to hold a stock for a long time will give you more success than jumping in and out of stocks, trying to time the bottom and the top. For example, imagine you have a tree that grows apples. If you leave it alone, it keeps growing more apples every year. But if you keep cutting it down and planting new trees, you have to wait for each new tree to start growing apples again. Stocks are like that tree. If you buy a stock and leave it alone, it can grow steadily over time, even if there are some bad seasons. But if you keep jumping in and out, you might miss the best apple growing days. For example, if you invested $1,000 in a stock that grew 10% each year for 10 years, you have $2,593. But if you missed just a few great days because you jumped out, you might end up with much less, which Warren Buffett, one of the greatest super investors of all time, agrees with. As he often says, the stock market is a device for transferring money from the inpatient to the patient. So Buffett also believes in holding good companies in the long term. A key thing that separates super investors from the ordinary investor is that they are able to find these so called good companies, which is very difficult and can take a long time. But it is much easier for super investors to clear out all the bad companies as they know what to actually look for. Now, one very important thing that the super investors do to find these companies is looking for companies that they understand, as investing into companies that you don't really understand will make the holding process difficult, because each time the stock falls, it will be hard for you to find an answer to why it dropped, as you don't understand the company, which also means making the decision to either sell or hold on to the stock will get more and more difficult as time goes on. And that is not a great situation to be in as a long term investor. For example, imagine you invest in a popular shoe brand you know and trust. Over time, as more people buy their shoes, the company grows, and so does your investment. Because you understand why the brand is so successful, you can then confidently hold your investment and benefit from its steady long term growth. Arguably, the most crucial thing that super investors tend to look at is the moat. And a moat is a business's competitive advantages. And if a business has a moat, then it is more likely to be here for the long run, because the moat makes it hard for the competitors to beat the company, as the business has competitive advantages. And a competitive advantage could be a brand reputation. For example, if you look at Apple, they have built a very strong brand reputation, making people buy their products even if there could be better options, which makes a moat. And the moat gives higher likelihood for the company to stay here for the next couple of years, and that we like as long term investors. Earlier, I mentioned Warren Buffett as one of the greatest super investors of all time, and one of the most important things to him is a great management. And a great management we can find by looking in the annual reports and seeing if the management is honest about their situation. For example, if they struggle with getting better margins, then we want them to admit that within the annual report, as that shows transparency towards the shareholders. Another great thing is if management is great at allocating capital, which means they reinvest profits wisely. For example, imagine a tech company earns 1 billion in profit. Instead of wasting it on flashy offices, they invest in improving their products, buy back undervalued shares, or acquire a smaller company that strengthens their overall business. Smart capital allocation like this grows the company's value and benefits long term shareholders. Lastly, we want management to have skin in the game, which means they own a portion of the overall business. Usually, over 2% ownership is great, but the management can also just have a big amount of their net worth within the company. And we like this because it means the management wants the company to do well in the future, as they have their own money within the business. So, if the business does well, the management gets richer. So, it is a great sign if the management has skin in the game. Now, the things we have gone over so far are important, but finding the true price or value for a company is just as important, which most super investors do. But how do we evaluate a company? Well, there's many different ways to evaluate a company, but super investors mainly use these two. First of all is using price to earnings ratio and price to free cash flow ratio. And in simple terms, the price to earnings ratio tells how much investors pay for each dollar a company earns. A high price to earnings ratio suggests high growth expectations, but can also mean the stock is expensive. And the price to free cash flow ratio is pretty much the same, just what you pay for each dollar of free cash flow. But we want to look for companies which might look cheap according to the current price to free cash flow ratio and price earnings ratio it has. And the way we can do that is to pay more for a quality company that has lots of competitive advantages and great management, and pay less for a not so high quality company. But how do we know what to pay? Well, a medium price to free cash flow ratio and price earnings ratio is around 16. So we could pay more than a 16 price to free cash flow and price earnings ratio for a high quality company, but only a few numbers higher, as it can become very difficult for a company to deliver the results of a 50 price earnings and price to free cash flow ratio. We would rather be in the range of 20 to 25 for a quality business. The same goes for a non quality business. Then we could pay also a few numbers under 16, but not higher. Now, the second method is way more popular amongst the super investors, as it is the model that comes closest to finding an actual price for a stock, and it is the discounted cash flow model. We use a discounted cash flow model to figure out how much something like a business or investment is worth today based on the money it will make in the future. Cash flow is used because it shows real money coming in and out, not just accounting numbers. Discounting adjusts for risks and time, since money today is worth more than the same amount in the future. Now, when we use this type of calculation, we usually want a margin of safety. And a margin of safety, put simple, is like a safety cushion. It's the extra space between what you have and what you need, helping you stay safe if things go wrong. So we could, for example, use a 20% margin of safety. Then we take away 20% of the intrinsic value, which is the value we got from our discounted cash flow model. Now, because these calculations are probably not going to be accurate, we take away 20%, as then there is room for error. And if the result is still undervalued, then it could be a wise investment. We use a high margin of safety if there's a lot of uncertainty with the business, and a low margin of safety if there's less uncertainty. For example, if a company has a moat, then we could use a lower margin of safety. But if a company does not have a moat and is within a tough situation, then we would like to use a higher margin of safety. The last thing that many super investors see as crucial for long term gains is looking for companies that aren't just going to be here today, but are likely to still be here in the next 10 years, continuing to hold up against competition. This is because it's these kind of businesses that generate significant returns over time, as they are built to last. These companies often have a moat which protects them, and they also tend to face very little competition. However, this is something you need to figure out for yourself and carefully think through as part of your investment thesis. So now you know what mainly separates these super investors from ordinary investors. But finding these perfect stocks that fulfill super investors' criteria can be very difficult. For example, one super investor, Monis Pabrai, says that a good investment year is made up of just finding two great stocks. So if you don't really know where to start looking, watch this video where I cover one of the best luxury brands, which also have a lot of the things super investors tend to look for.